Hello everyone and welcome to our autumn budget. Today we're going to focus on what the budget actually means in practice for business owners, directors, landlords and families. We're going to break down the real world implications of the announcements following last week. And today myself, Tracey Metcalfe, am joined by Susi French, who specialises in estate planning and family wealth, and by Ed Gooderham, who specialises in tax strategy, remuneration and the wider economic impact. So we're going to work through various topics, including personal taxes, remuneration, savings and investment rules, changes to estate planning, business investment incentives, people strategy, property taxes, electric vehicle road charges, and a few smaller but important technical updates. So we're going to begin with looking at the area that affects most people, which is personal taxes and fiscal drag. So last week, Ed, in your budget summary, you talked about fiscal drag. Can you talk us through this and why it's such a big theme again this year?
Thanks, Tracy. Yes, so none of us knew what fiscal drag was until it was announced a few years ago in one of the previous budgets, where they freeze the thresholds when we start to pay tax, so our personal allowance, and also the different rates where different tax rates start and stop. So what she announced on last week was that we're going to extend the current freeze on the thresholds for another 3 years until 2031, which seems crazy talking about that in 2025. But what that does, it means that a lot more people will be dragged into paying high rate tax at 50,270, and some people will even be dragged into starting to lose their personal allowance at 100,000, which is where you might hear on the news where people are starting to pay more tax, and they're obviously saying that they are increasing the tax for normal working people. The other big issue with this is that having these rates not changing or fixed to not change for the next 5 years, and when you've got inflation running somewhere around 3% at the moment, which is a lot less than it was, obviously all our costs are going up, so people want to have more income. So directors want to take more money out, and that's causing them now to having to decide whether they pay high rates of tax, because a lot of them want to keep under that 50,270 with husband and wife. And now they're starting to think, well, I'll go past that. They've got up to 60,000, which is the next threshold if they've got young children for them to look at. Between 60 and 80, they then lose their child benefit and get that clawed back on their tax return. And then I've got other clients who husband and wife take out £100,000 each and have been for a couple of years. And then I was saying, well, actually, that's not enough now, because we're just going to have to start losing personal allowance and go through that barrier, because these rates just haven't changed for several years already, and now for another 5 and a bit years going forward.
Yes, and on top of that, you're going to have the national minimum wage increases as well. So how is that going to affect businesses going forward?
Yeah, so this was announced the day before the budget, that the national minimum wage is going up for over 21s from £12.21 to £12.71, which is 4.1% increase. The big knock-on effect of this is that everyone at the bottom goes up, and then everybody above them wants a pay rise. The government keeps saying they're not trying to cause inflation, but when you put the bottom figure up by 4.1%, and everybody else wants 4.1% above them, that automatically causes extra costs in businesses, which you then pass on to clients, increases your prices that you're going to charge. And that, sadly, at the end of the day, it's always the end user who ends up getting the hit for these extra costs, as these get passed down the chain until the end person pays for it. But yeah, it's a big issue. £12.71 on a 40-hour working week is now looking, I think it's somewhere around 25,000. Just do the maths very quickly. Actually, it's 26,437 now, which isn't a small wage when you consider that's a starting point for any job now. So that's the other thing that clients have to bear in mind when they're looking at employing people, that that's the starting point for anybody you employ if you're working 40 hours.
Yeah, so you talked a bit about tax bands as well. So looking at remuneration and directors' pay, there's been, first of all, a change in the salary sacrifice on the national insurance cap for £2,000. So previously, the salary sacrifice meant that employees could have relief up to 28% for that being 20% income tax and 8% national insurance. But obviously, with this new cap coming into effect, how is that going to change what changes are going to be for employees and employers?
So yes, this salary sacrifice change, which he announced, most people think, well, it doesn't affect me. I don't earn big money, therefore this £2,000 doesn't affect me. The problem is you only have to be earning £40,000, and then your a 5% contribution that you're making as an employee, if you're under a salary sacrifice scheme for your pension auto enrolment, you'll be at £2,000 of contribution. So this will affect an awful lot of people. Now, the good news is it's not coming until 2029, so there's some time to play. And the cynical part of me wonders if they'll still be there in 2029, but we'll see. So yes, so we need to have a discussion about how best to do this for people. It doesn't actually affect directors. So if you own your business and you want to put £60,000 to your pension fund, which is the maximum you put in each year, that isn't a salary sacrifice. So salary sacrifice, you have to have a salary and you have to be sacrificing part of it. Whereas directors, you're on 12,570. If you choose for the company to make a contribution on your behalf, you're not sacrificing anything. So it doesn't affect directors in that way. It mainly affects employees. So I have several clients who might be big earners and they need to do tax returns for rental income or other things. And say they're on £99,000 salary and then they get a 10k bonus. A lot of times they'll put a 10k bonus into their pension so they don't lose their personal allowance and end up with getting hardly any of it, which is great. And often you can speak to the employer and they'll add their 15% employer national insurance to it. So you get a nice big pension contribution. Well, that's the sort of thing they're trying to tackle and saying, sorry, we're not going to give you that anymore. And if you want to still put that into pension, fine, but you're going to have to pay national insurance on it as an employee, like you say, at 2% if it's a high rate, 8% for a low rate. But the employer will have to pay 15%. So this is, again, really a cost to the employer, not the employee. And it's just trying to hit us again. Like I say, it's 2029, so you've got a couple of years to change things before that. But I fully expect some people to look at how they're doing their pension auto enrolment, and either to have two schemes, one for the people up to the age, up to salaries of 40k, and they carry on doing salary sacrifice, and then possibly once they're over 40k, changing it to the different scheme where they're not doing salary sacrifice. Unfortunately, that's the possibilities I've heard of that people are probably looking at going forward. So there's lots of issues with it, but like I say, sadly, they're just trying to hit the employer again. The employer is allegedly saving 15%, although a lot of times the employer will pass that on to the employee. So unfortunately, it's just reducing the helpfulness of these things, which has been around for a long time. And I can't believe the government's going to raise that much money from it. But
like you said, there's two things that are affecting employers, and there's also the national minimum wage and this, if it comes in 2029, the salary sacrifice scheme. So looking at directors, their remuneration. So currently a lot of our directors take a combination of salary and dividends. Dividends tax has now been increased by 2%. So the basic rate taxpayer is going up to 10.75%, and higher rate taxpayers from 33.75 to 35.75. So is this going to have an impact on remuneration planning, and should they consider paying themselves differently going forward?
yeah, so I ran some numbers last week on this to have a look at it. And if you're a director, owner of a business, you're still slightly better off paying yourself a small salary of 12,570 in dividends up to the 50,270. You're about £1,900 better off compared to salary. The other benefit is you take more cash out because you pay corporation tax and then take the dividends out and pay personal tax on it. You can actually extract more money still up to the 50,270 before you hit that higher threshold. So it's still the best if you are a limited company already up and running. The difference comes when you get to higher rates. There's basically no difference between being an employee and the paying yourself via all salaries or paying yourself a dividend and salary route at high rate. It's almost spot on the same figure. So you get the saving at the bottom of 1,900. Once you get past 50,270, you're no better off. And that's partly why she didn't add it to the top band as well, yes, the additional rate. Because if she had, then it would have made it so that it made more people would have said, there's no point doing the dividend route. I want to take out 125, 150,000 pound. Therefore, I'll just take it all the salary. So there's still a benefit to business owners to taking small salary dividend. The big one to look at actually isn't employees, it's at the low end of the scale and looking at people who are self-employed versus limited company. They might be looking at incorporation. That's where you've got a massive divide now, because when you've got corporation tax at 19%, going up to 26.5% once you're over 50,000 for a single company, plus then you've got dividend tax at 10.75. Being a sole trader is actually more tax efficient and cheaper in tax than being a limited company and paying yourself as a director with a low salary and a high dividend. So almost every level, there's a couple of little ones at 19% where you're slightly better off, but literally £50 better off. At most levels, you're thousands better off as a sole trader. If you're withdrawing all the money, I have had some other clients who they don't draw the money out, therefore they're far better being a limited company than sole trade. So yeah, that's the one that's probably not getting mentioned enough, that those are the people who are running lifestyle businesses or very small businesses where there's not much of a risk, so limited liability isn't a huge issue. They're better to be a sole trade or partnership than a limited company.
Okay, and Susie, let's get you involved in the conversation. So there's also been a 2% increase in tax rates for people with rental and savings income. So what does this mean for people going forward?
Okay, so obviously savings income and rental income, up to 22% for basic rate, 42% higher rate, and up at 47% for additional rate. So they did get the 2% added on additional rate for that one, unlike the dividends. The actual savings allowance is unchanged at £1,000 for basic rate, £500 for higher rate. So with these things, it's just literally just hitting harder, higher tax, because one of the things that people thought might happen before the budget was they thought they might add national insurance on for landlords. But then if they'd done that, they're obviously, national insurance cuts out at retirement age, so they can't charge above that. So by doing this, they've a lot of people who are retired have rental properties. So they'll be paying higher tax on those rental properties than they would have been.
Right, and staying with you, Susie, we're going to next look at savings and ISAs. Can you talk us through what the changes have been made to ISAs, particularly the 8,000 investment requirement for the under 65s?
So ISAs have been popular for a long time because you don't pay any income tax on any interest, you don't pay any tax on any dividends, no capital gains tax on any investment gains, and you don't have to tell HMRC about any of it. So ISAs are quite nice, and people have used them for a long time. You can put up until now you've been able to put up to £20,000 into your ISA each year. What type of ISA you use and how much of each type you've used has kind of been up to you. And in the budget they've just had, £20,000 limit stays at the £20,000 limit, so you can still put £20,000 into an ISA. However, if you are under 65, they've said that of that £20,000, £8,000 of it must be put into an investment ISA. So I'm assuming this is to do with them trying to encourage investment rather than just people having savings income. So it does make it a little bit less flexible. Obviously, for the over 65s, they can still put their full £20,000 into a cash ISA as they did before. So there's no change for them. It's just really for the under 65s.
Yeah, so Ed, what Susie said there about the investment, is that why this has been put into place, do you think?
Yeah, well, again, the Chancellor said a number of things, some positive, some negative in terms of investments. They are trying to encourage more investment into the stock market, which is why they're pushing this. It was interesting that I got some clients who put money into VCTs each year, which get 30% tax relief historically. And she's reduced that from next year to 20% from 30%. So that's not encouraging people to invest into companies and the stock market. So that was an interesting flip side. One thing that she was saying was that the limits that the size of the businesses that can do VCTs, they're increasing. So it might get more stronger businesses rather than the more risky businesses historically, which might be the argument for reducing the amount of tax allowance they're giving on it. The other big thing with savings is a lot of people don't use their first savings band of £5,000, which everybody has. If you've got income or savings income between 12,570 and 17,570, that's taxed at 0%. So we do this a lot for our clients where they've got a salary of 12,570 and then they've got director's loan accounts where we can charge interest on that and utilize that very efficient band for £5,000 taxed at 0%, but you get corporation tax relief on paying the interest. So we've kept that, which is good. That's very useful for some clients. And obviously people, if they've got a lot of rental income and all they've got aside a lot of interest income and they've only got their state pension or a small pension, then that can be very useful for them as well.
You mentioned VCTs there. The tax reduce has been reduced from 30% to 20%, but they still attract the other benefits going forward, don't they? Like dividend income is tax-free.
Yeah, so VCTs are very good. Again, Susie mentioned the fact that ISAs you don't have to record on your tax return. VCTs, the dividends they pay are tax exempt, so you don't have to record those either. And historically, VCTs have paid out between 4 and 6% a year in dividend income. So I've got several clients who use those mainly to get the 30% tax relief on day one, which is the bit that's obviously reducing to 20% sadly from next April. There's still EIS, which is another form of investment, and CDIS, which actually gets 50% relief on, but they're a lot more risky because they're a lot smaller businesses.
And there's also been some changes to capital gains tax relief for employee ownership trusts. Can you explain what these are and the impact of them?
Yeah, so employee ownership trusts were something brought in a few years ago where a business owner can sell their business to their employees via employee ownership trust, which is a great idea, giving your business to the workforce. And historically, you had 100% exemption from capital gains tax, which is very nice. You kept all the money that the trust paid you for your business. So you can see why there was an incentive for the owner to do it. There's a slight few issues with the employees getting it because there's limitations on how much dividends they could pay. There's rules with tax related trusts. So it didn't make it the most tax efficient way for the employees to own it. But it's mainly geared for people selling their business and paying no tax whatsoever. And when you've got the business asset disposal relief increasing from 14% to 18% next year, there's more keenness on obviously saving that tax from business owners. Obviously, more people have done this than HMRC thought were going to, which is why they changed the rules. And that was very clearly stated that basically it's cost them too much. So instead of getting any money whatsoever, they've now changed to 50%. And the other thing in it is you get 50% of the gain written off, but then you don't get BADR either afterwards. So you're then paying 24% on the gain that you're making. So people really need to look at it now to see if it is worth doing. And also because of what I said about the employees, it's not always the most tax efficient way for them to extract money and use it. But I have seen I've heard lots of businesses do it. I haven't advised any of my clients do it. But yeah, we do come across it every now and again.
So you mentioned the business asset disposal relief. Obviously, that was one of the changes announced in last year's budget. And also in last year's budget, there was huge or major changes to inheritance tax around agricultural property relief and business property relief. And Susie, there's been another development this year around the £1 million allowance. Can you explain what that is and how it's working in practice?
Okay, so yes, so the 2024 budget caused, obviously, especially in the farming population, quite a shockwave when they brought in a £1 million limit on the amount of agricultural property relief / business property relief. They just amalgamated them together, and the most you could have at 100% relief was £1 million. So this is obviously where people fulfill certain criteria, whether it's farming business or other trading businesses. But farming business, it seems to hit a lot more because farmers historically, they hang on to their farms to the bitter end. So they can't even crawl around it anymore. They hang on to that farm forever. And they do not hand it down to the next generation until they die. And it's just classic farming sort of business. And it's how it's always been done, because they get the uplift for capital gains tax to the probate value. So if children do need to sell a bit of land to sort of, because quite often assets go here and there between different children when families may try and even things up, and they may need to sell a bit of, bits and pieces off so the farm can continue as a core. So they always wanted that uplift to probate value, so that if anything was sold, there was no capital gains tax, by the next generation. So that was why the farming families always hung on to the farm as every generation to the bitter end. So by bringing this £1 million limit in for the 100% relief from IHT, most farms of any size for a farmer are over that limit. So for a couple, as they brought it in 2024, each husband and wife would have got £1 million each. But the problem with that was, if the first one, because they classically, not only do they hang on to the bitter end of the farmer, they will do a mirror will and pass it to their spouse. So again, held on as late as possible in that generation. But if the first person didn't utilise that £1 million under the 2024 budget, it was gone. Because obviously there's an exemption when you pass stuff on to your spouse for inheritance tax purposes. There's no IHT due. It gets upgraded to the probate value, but no IHT. So the surviving spouse, when they died, they would only have £1 million relief at 100%, but they would have the whole farm left in their name. So this was obviously causing problems. And because obviously farmers have these mirror wills, they've had these mirror wills for a long time, and they weren't necessarily getting out and getting them changed that quickly for the new rules. But also there was a bigger problem. So say if the first spouse died, I don't know, 2.5 years ago, long enough ago that they couldn't do a deed of variation on the will and change it. So they'd missed that 2-year deadline. But actually, they'd passed everything to their surviving spouse. There was nothing, no get up for them. They couldn't go back and retrospectively change that. And so everything is passed on to the second spouse. They've just got their £1 million. And actually, they were a little bit, quite frankly, stuffed at this point. There was nothing, there was a limit to what could be done. Because obviously they may try and pass assets down earlier, but if they're already elderly, they've got to survive 7 years for that to work. So again, another flaw with the problem. So the 2025 budget, they've brought in that £1 million 100% relief, just like nil rate band, residential nil rate band, which are the other reliefs that everybody gets, are to be transferable between spouses. So this, it doesn't take away the problem, but it softens it a little bit. And it was an inconsistency with the other sorts of reliefs that there were, that you couldn't pass it between spouses. So that does help. However, it is still important, because £2 million for a farm is actually not a lot of assets, because you've got to take into account all the things that people didn't think about before, because they just automatically got, went through the probate, there was no inheritance tax. People didn't worry about how their livestock was valued, how their plant machinery is valued. That will all be taken up to a probate value, not the value that it's in the accounts. So when people might think they haven't got a problem, the value that things are being carried out in the accounts are not necessarily what the probate value will be. So it's still really, really important for farmers to actually look at what they've got, at current values, and actually figure out if they have got an issue, and actually get someone to look at it, consider earlier rather than later if they want to start passing things down to the next generation, so that at that higher generation, they are left with just enough to use up those reliefs that they're going to have. Obviously, allowing for the fact of their lifestyle choices as well and things like that. But, it's worth looking at these things, doing a review, and looking at what they need to retain and what can actually be passed down a generation.
Thanks, Susie. That's a lot of good advice there.
Tracey,
So-
sorry, with that, I mean, the whole inheritance tax, we're doing a lot of inheritance tax reviews at the moment, because clients are obviously very worried about this, business owners as well, because the BPR's £1 million. We've also got the pension, which was obviously announced last year as well, changing from next year. So a lot of clients are looking at, well, hold on a second, we're only a year away, and a few months away from the pension coming into it as well. What should they be doing about their pension funds? Because I've got plenty of clients who've got pension funds from £500,000 up to £1.8 million. And when that's part of their inheritance tax liability, part of their estate from next year, that's a very large tax charge of 40%. At least with BPR, we get £1 million free, and then it's only 50% or 20%, 50% of charge. So it's 20% charge in terms of what you actually pay on the balance of it. With the pension, it's 100% is taxable, and therefore you're paying a 40% charge on it. So that's a bigger issue in one sense for a lot of clients. And we're looking at drawdown, paying money to family members if we can do, and using up their bands up to £100,000. They're paying 40% tax, but they're paying a guaranteed 40% tax now, giving the money to their children, and it's then in the children's estate or the grandchildren sometimes. Whereas if they died with this figure, they'd pay pension inheritance tax on it at 40%, and then the next generation would pay income tax and get it back out again.
Mm-hmm.
So there's lots of issues still with inheritance tax, with BPR, which is more favourable than the pension. It's not as favourable as it used to be. It used to be 100% everything, which was great. There's also, though, for some clients where they might have sold their business, so it goes from being allowable against inheritance tax to now being taxable when they've got £1 million sat in the bank. And then we're trying to look at what can they do with that to put it into something that gets business property relief again. And there's several investments they can do with an IFA that will give them BPR relief again. So there is options available to people. And certainly there's lots of negatives, like Susie said, for farmers and for business owners who die with owning part of the farm or the business. But there are some positive options for people who historically probably haven't thought about BPR and APR as an option for them to reduce their inheritance tax. So with every loser, there's always a winner as well. So you have to, with planning, it's always looking at what's best for that person, but there are always opportunities to reduce these tax liabilities if you plan early enough.
That's the advice we want, isn't it? Because like you said, everybody concentrates on the losing side of it, where there are possibilities there as well. So another change that's coming into effect is capital allowances. So Ed, if we can give an overview of the annual investment allowance, which has been there for a while now, there's going to be a new first year allowance introduced from April, and there's also a reduction in the writing down allowance going forward.
Yes, when she announced this, I was a bit confused. I thought, okay, we've got first year allowances, we've got full expensing, we've got 100% allowances on certain things like cars, and electric cars are 0% emissions, and the installation of charging points. So I couldn't quite work out why this 40% came from. Was she scrapping everything else? So I had to read full small print to realise she wasn't scrapping everything else. This 40% first year allowance is coming for two reasons, as far as I can see. One is for companies that lease assets to people. So if you're a plant hire company or one of those sort of things, or van hire company, this is beneficial to you because you can get 40% first year allowance on the assets. And it's also for partnerships and sole traders, because some of the other reliefs, the annual investment allowance, aren't available if you're not a company. So there's a benefit there for them. So this comes in from January 2026. Like I say, the old ones are still staying. So annual investment allowance, which all companies can get, is £1 million of the first £1 million of expenditure, which is great. And that covers 90% of our clients. We have a few clients who spend more than £1 million. So the 40% might come in if they want to use it, if they can't use something else like full expensing or one of the other reliefs, depending on what they're buying. The 40% first year allowance isn't available on cars, so that's just something else to mention. And then you get this writing down allowance, which was reduced from 18% to 14%. So like I say, if you've got less than £1 million you're spending, you've written everything off anyway, so you don't even have to worry about this 14% writing down allowance being reduced from 18 to 14. It only comes into effect if you've got like a first year allowance of 40%, so you've got 60% left. And what they're saying is that 60% left over, the next year you get 14% of that 60% against your profits for that year. So that's what the change is. But like I say, it shouldn't affect most of our clients. There's some good news for leasing companies and obviously sole traders and partnerships with the 40% coming in. But other than that, it's not a huge announcement.
Just say some good news for them. Is it worth them delaying any major expenditure until when these new limits come in?
It depends in terms of what expenditure they're doing, if it can't meet one of the other criterias. You need to look at each one individually and the cases. So some people it might be, if they can't get relief at the moment, wait till January to get 40%. But like I say, most people, they'll get £1 million and therefore go and spend the money as you would normally, and you'll get relief for it against your taxable profits in the year you spend the money.
There's also been some changes announced to apprenticeships. So we're looking at people strategy. So the funding has been expanded again. So there's now more funding for under 25s for small and medium enterprises. And we see full funding. The aim of this is obviously to encourage employees to take on and train younger staff and to offset some of the rising costs of wages and national insurance, particularly with national minimum wages going up. So it does give them an opportunity to grow through fully funded apprenticeships and also employee NIC exemptions. So that now we're going to look at enterprise management incentives. So why are these schemes so effective, Ed, and for high growth and owner-managed businesses?
So EMI schemes are a more flexible way of tying in key personnel and giving them ways to increase the when the value of the business increases, they get more of a lion's share of it if you set the schemes up correctly. I think we've only got one scheme with a client. They're quite expensive to put in place, but this is just giving more scope for them, which is good news because more businesses are realizing tying in key members of staff is good for business. So anything that helps you to attract and retain your best staff is a good thing. So it's worth looking at, seeing if it worked for you, if you're happy with the cost of doing it and the reason for doing it. I mean, the whole thing with these things is you've got a plan for your business in terms of what your exit strategy might be one day or how you want to grow the business, and those key personnel that you want to tie into that. This could be a way of doing that in an efficient way, both for the business and for them. So it's worth looking at. There's lots of reliefs with it, but it's quite detailed. So happy to talk that through with anybody if they like more detail on that.
Okay, thank you. One of the other changes is the high value property surcharge. So this is for additional annual council tax charge per year for main residences. So it's starting at £2,500 for residences over £2 million and going up to £7,500 for properties up to £5 million. So Susie, who realistically is going to be affected by this new surcharge on homes? And it's not going to be me.
You sure? So realistically, my guess would probably be a lot of properties in London, a lot of properties in the southeast of England. You know, there's other sort of high value sort of spots in the UK, like probably around Cheshire way, you know, but realistically in Wales, probably less of a problem. You know, the lower end of it may kick in somewhere, but you know, properties in Wales tend to be less expensive than places like the southeast of England and London. So, you know, it's going to kick in on high value properties where it's, you know, someone's main residence. And, you know, there will be a few in Wales that get affected by this, but probably less so. Probably maybe some into Herefordshire or Gloucestershire over the border, where we do have some clients may get impacted by this. But it will tend to be in the higher sort of house value areas where this kicks in. Yeah.
Okay, thanks.
I think there still has to be agreed that Wales are taking part in this, and I don't think it's coming in until 2028 or 2029. It's 2029.
April 2028 it's coming.
Yeah,
in.
so far it's been announced for England, isn't it? So it depends whether Wales follows suit, isn't it?
Yeah. So the Welsh budget normally comes out in the new year, so we'll wait and see what they say about these things. Like you say, Susie, there's not a huge number of £2 million plus properties. There are some. It's whether they want to include this or not.
Yeah, so it will be probably the only clients that we tend to have that will be impacted is our clients probably on the English side of the border in Gloucestershire and Herefordshire.
Okay, thanks both. And there's going to be, so obviously over the past few years, it's been very advantageous to have electric vehicles. But now from 2028, they're introducing a vehicle mileage tax. So it's going to be 3 pence per mile for electric vehicles and 1.5 pence per mile for hybrid vehicles. How this is going to be implemented is yet to be confirmed. But is this a way of beginning of EVs becoming more like tax like petrol vehicles on the road? Ed, you take a view on that?
Yeah, so you can understand what they're saying, that if you go and buy a load of fuel, it's got an awful lot of duty in it. Whereas obviously when you're charging your car at home or at the office, you're just paying the electricity charges, which have sometimes very, very low rate of VAT and also no duty built into it. I did some numbers on this for myself. I literally just changed to an electric vehicle last week. I do about 16,000 miles a year. So it cost me about £480 a year in this fee. Now, the big issue is most business owners have brand new vehicles which don't need MOTs. So how are they going to get the details of the annual amount of miles you're going to do? I can't believe we're going to all go to the company that services it and they're going to send the information to HMRC, but we'll wait and see. They've got a couple of years to work out how they're going to actually administer this. I can understand why they're saying to do something. I don't know if these rates are the right rates to do it at, but like I say, £480 a year when you're already making a big saving by having electricity compared to fuel, it's not a big issue. The bigger people, if they're doing a lot of miles, then there might be a bigger impact. And the hybrid one is interesting at 1.5, depending on how many miles your hybrid does on electric. Seems you're already paying for fuel and putting a lot of duty already. So we'll wait and see how they're going to actually roll this out.
It's also been another change for electric vehicles, hasn't it? There was a higher road tax charge, wasn't it, on £40,000 value on vehicle, which has now been changed.
Yeah, so they've increased that. I think it's also they've increased the starting price when you get the grant as well for EV vehicles as well to the same figure of 50,000. Which again, if you buy an EV vehicle, there's a grant available. But most clients again don't choose to buy electric vehicles because of the end value of them is so unpredictable. So most clients would look at leasing their vehicle over 3 or 4 years, depending on the warranties. Just they got a guaranteed fixed figure for how much it's going to cost them in terms of running the vehicle, rather than buying it and then suddenly realizing, like a couple of clients who bought Porsche Taycans, very nice cars, had them for about 6 months one client, 18 months the other, and the values had dropped massively by 60%, 70%, which was just ridiculous. But it's just because nobody knows the value second-hand of electric cars. So just be careful with it. But like I say, most clients lease them.
Okay, and then just before we round up, there's a few technical points that's been announced in the budget. One of them is over incorporation relief and the other EPT loans settlement. Can you just mention them, Ed, briefly? Yeah,
so incorporation relief is interesting. So historically, you've automatically been given incorporation relief unless you opt out of it. And the change is that from next year, you're going to have to actually elect to actually claim incorporation relief. So you actually tell HMRC that you want to claim it and put it on your tax return. So if you don't, and then you want to do it afterwards, you're going to be too late. So I'm not quite sure why HMRC is changing this, but just be aware of it. So any clients who are looking at incorporating, like I said earlier, you're tax-wise, you're worse off as a limited company now than an unincorporated business. But there are other reasons for incorporating, like limited liability. So there are still pros and cons to looking at incorporation, but just to be aware that you do, going forward, have to actually apply to be incorporated and put on your tax returns. The other one is the EBT loans, which is very interesting. Sadly, this goes back to 2019 when they brought out a new EBT loan charge, which sadly some people did commit suicide on because they suddenly got hit with tax bills of hundreds of thousands of pounds and just didn't know what on earth to do. The government, I mean, we're in 2025, almost 2026 now. It's taken them a long time to decide that it's not really fair what they did. And the big problem really is that if you've settled your scheme with HMRC and you're paying your payments, you can't do this new settlement, which seems very unfair when this new settlement seems the fairest I've seen so far, where there's certain, you get discount for the amount you've paid to the promoters, so that those payments possibly up to £10,000 that you paid the promoter for doing the scheme. There's some other reliefs you can claim as well. And for some clients, they're estimating up to 30%. They won't have any tax charge at all because of the reliefs that they're giving. So if you have got an EBT loan still outstanding with HMRC and you haven't settled it yet, you do need to have a look at this mechanism, and it probably would be a good idea to settle it with these new rates. It's the most favourable, like I said, I've seen, so well worth looking at, and we can help you with that.
Okay, thanks. So just to recap, we've covered a lot of different areas there, including personal tax and fiscal drag, remuneration and dividends, ISAs, savings, updates, estate planning changes, capital allowances, apprenticeships, EMI schemes, property taxes, electrical vehicle charging, and a few technical points as well. So if we had to take one line takeaway from today, Susie, what would yours be?
Just because the £1 million APR BPR at 100% is now transferable between spouses, it doesn't take away the need to still plan for IHT, because most farms, by the time you've taken in their machinery, their livestock, are well over £2 million. So planning is still needed.
And Ed?
Unfortunately, of late with all these budgets, there's so much announced for the years to come. In one sense, it gives us certainty, but in another sense, having things set in stone so many years in advance is quite demoralizing. Like the fiscal drag, where you know the tax rates aren't going to increase, so therefore if you want to take more money out, you just have to pay more tax, and a lot higher rate tax. I mean, so planning is needed. There is lots of options still in terms of looking at reorganizations in businesses. So I do a lot of work with clients looking at alternative ways of taking money out of the business over the long term. So that's well worth it, because especially with tax rates now at 10.75, which isn't too bad for dividends, but certainly 35.75, it's becoming very expensive at a high rate. It's well worth looking at alternatives and looking at some long-term planning for clients. Inheritance tax is a huge issue, as Susie's already mentioned. We have a lot of clients who are over the age of 50, and looking at inheritance tax is very important. And so I spend a lot of time looking at various options for clients, and we can reduce inheritance tax massively just by some good planning over 5 to 10 years. So that's another big area to look at, especially with the tax changes coming next year, with APR, BPR the year after, with pensions. It's well worth doing that now and putting things in place.
Yeah, so if I summarise that, I'd say it's a really good time now to review your remuneration strategy, investment approach, estate planning, and also your staffing plans. We mentioned a lot about employees with different changes in staff going forward. So if any of the areas are of interest to you or particularly relevant to your situation and you would like further advice, please do get in contact. We'll be happy to help. We also recommend you watching our roundtable from last month, which is the IHT, which gives more deeper context of estate planning, especially around families and business owners. So just want to say thank you all for watching. Thanks Ed and Susie for all your advice there. And don't forget to like, share and subscribe.